God damn it, I'm retarded as shit. The screen there went blank for a while. Sorry, everybody. But yeah, what I was trying to show you, I'm not sure how much of it got cut off, so I'm just going to briefly go through everything again real quick and kind of just run through what I was trying to show you. I have no clue when it started to cut off. I haven't looked. I'm just going to blind it here. I started looking at, all of the 13 Fs that came in from Fintel. I'm showing you that you can do this on your own behalf with public data. It's all out there. You just got to connect all the pieces together. But you have 13F holding reportings coming out for whatever stock you want. Fintel, type in GME AMC. But what you notice in all of these stocks, most of them, a lot of them, is the institutional ownership. It's very similar. It's made up of different things, such as insurance companies, trust funds, index funds, you name it. It's in there. Bunch of shit. And essentially, it's a part of the overall plan that the Fed had to clean up the ginormous mess that's in the markets. And you go look into all these holdings of these companies or all of these mutual funds and ETFs and things like that, all these trust funds, and you go and you look inside of them, like SPACs, for example, which is a very well-known and widely used government money market fund. Anybody that has a Fidelity account that trades options or stocks likely has one of these sitting in their account that is used to manage their cash. When you have your cash sitting in there, this is where it's sitting. And guess where that cash goes? To the repo market. And the repo market was the Fed's tools. You heard it in all the FOMC meetings. He always would refer to their tools. And their tools amounted to, in large part, the repo market. Which, if we look at the repo market from the Fed, and we go back throughout history, nothing ever in its history like what we saw happen in 2021 has ever happened before, and will likely never happen again, because what we saw essentially, if you break it all down in a nutshell, what we saw happen is this. The rates were lowered to damn near zero during the COVID pandemic. One can argue about the planning of COVID. There's a lot of things heading in that direction. A lot of it is very speculative, of course, but there's a lot of questionable things that are tied together when it comes to that and all the timing of the events and the macroeconomic policies that came out of the Fed, so on and so forth. But essentially what we had happen is the rates were lowered during the COVID pandemic. Everybody was locked up. Everybody was home, essential versus non-essential workers, this and that. But what's important to notice is that during that time, when the rates were low, this is when the big three, Vanguard, Fidelity, and BlackRock, were acquiring all of the securities in the market. What they were doing is stuffing them full of essentially ETFs and mutual funds and all this other shit, and they're chaining it through collateral chains with their mutual money market funds, which is exactly what I just showed you, the SPACs government money market fund that everybody has that has a Fidelity account. Now, if we look at the monthly fact sheet, the prospectus, we look at the monthly holdings report for the SPACs, we can look in here and we can see that there is government agency debt from U.S. government, and we have Federal Farm Credit Banks, we have home loans, a lot of home loans, Federal Home Loan Bank, feels like 2008 again. Home Loan Bank, a lot of home loan bank shit going on here. But what's important to see here is when you get down to the repurchase section of their holdings, that's when you start to see things like Bank of America and Bank of Chicago, and BNP Paribas, Bank of New York Mellon, who is also facilitator of the GCF repo. Then you have Bank of America, Canadian Imperial Bank of Commerce, Citigroup Global, FICC is in there. The FICC itself, the GC repo, is in there. State Street is in there. Goldman Sachs, every big bank you can imagine is in there. Morgan Stanley, so on and so forth. They're all there. U.S. government agency repurchase agreements collateralized only by U.S. government agency securities, U.S. Treasuries, and cash. Then you have U.S. T-bills, which is U.S. Treasury debt. Then you have U.S. Treasury repurchase agreements, if collateralized only by U.S. Treasuries, including strips. Now, this is where a lot of people get it wrong. I got a lot of backlash in 2021 when I tried to tell people that they were buying up securities with the repo, because there's multiple different kinds of repos. There's Treasury, there's agency, and then there's what's considered other. And then if you go, there's actually a section in here that shows the other. And again, JP Morgan, Lloyds Bank, all of these different banks are involved in this. And, well, that's it, actually. Where's the joint? I thought there was a joint trading account somewhere. Maybe not. There used to be though, and God, I wish I can go back and look. Maybe I can go back and find one from an old video. But there used to be joint trading accounts in here when the repo was on its way up. And essentially, while the rates were being raised, if we go, we can just look at a chart actually. For the SPX, I have this all marked. I have it all marked out, all of the macroeconomic events that took place essentially during the critical time. Go to the chart. Whoa, let's go to single chart grid, SPX. Let's go to the weekly. Let's go to the daily actually. So if we look, let's go to the weekly actually. I think maybe it's a SPY that we need to look at. No, did I erase them? That sucks. SPX again. Yeah, all of my my shit's not there. It works on my phone, but for some reason it's all weird looking here. But essentially, if you look at this section, like this is when the rate hikes took place. Right there. During those little windows of time, at the very fucking bottom of the 2022 downtrend, is when the rates got to their high peak. And then what do we see happen? We saw the fucking massive bull run, AI, whatever you want to call it. But then that's the same time, if you go look back to this repo chart, that the repo started to decrease right around May 18th of 2023. If we go look, the market, you go look here, this is around November, right? That's when it all started. You go all the way up. This is the weekly. Keep that in mind. This is the weekly. So just nothing but straight the fuck up. Straight up. And really straight up all the way through March 2024. You'll look at the data again. March 2024 was about right here at the bottom. Right there. And we're still trending down. But that is what has been controlling the price action this whole time. And yeah, that's what I was in part trying to show you, is that you have the repo market right here. This is the chart for it. You have the repo diagram, which let me find that, which is right here. This is the repo diagram, how the flow of cash and securities works. You have the players involved, which is hedge funds, mortgage rights, broker-dealers, pension funds, sovereign wealth funds, mutual funds, insurance companies, exchange-traded funds, lending agents, which is newly added as of 2021, which Fidelity is a lending agent. They split their cash and non-cash collateral into two parts. Then they take the cash collateral, guess what? They reinvest it right back into the repo market through none other than insurance companies. So if we put the building blocks together, by the way, this green square means tri-party settlement, meaning the Federal Reserve acts as the central clearing counterparty. Bilateral settlement, this smaller box here, there is no central clearing counterparty, and that is where hedge funds and broker-dealers come into play, which is where our securities are in play. Hedge funds and broker-dealers, they lend the cash, they borrow the securities, and then lending agents can go both ways. And then they reinvest their cash in the repo market. So it's a big intersection of cash and collateral. Well, all major players are a part of it. And you take these big players like hedge funds, broker-dealers, pension funds, mutual funds, insurance companies, exchange-traded funds, hedge funds, and all that other shit. Where can you find all these players? Well, back to Fintel, right here, in most holdings, institutionally speaking, in a lot of these equity stocks. All of them, same shit you see within the holdings. So again, to put it all together, you have the holdings themselves of a stock. In this instance, it's GameStop. You have variable trusts. You have insurance products trusts right there. You have REITs in here. I saw one of those. Where did that go? Let's Control F for it. REIT. No, maybe there is no REITs in GME right now. But we do have insurance. We have Vanguard, which is Total Stock Market Index Fund, ETFs, and then big banks and big players like pro funds and things like that. So it's all there. And you go back to the diagram, and you can see how they're all involved here. One side's lending, one side's borrowing. Simple as that. The reason why they're using this and the motive behind it, this is how they get out of the net stable funding ratio that was passed by the CFR, by the code of fucking federal regulations, passed it to prevent these players from using short-term financing to fund longer-term obligations. That's what it was designed to prevent from happening. That is what the repo effectively bypasses and allows to continue happening, with the Fed in the driver's seat for tri-party settlement and the FICC taking control of the GCF repo, which is cleared by none other than Bank of New York Mellon. So it's all interchanged. It's a big club. Now, that's the repo market, how it works, how it operates, the players involved, and the players in the repo. It's essentially collateral chains, right? Big fucking collateral chains. Then you have the reports on the report side of things, which again, you can see FICC, Bank of New York Mellon, everything we just saw on that repo diagram, and then we have all the big banks. Now, if we go look at the other end of this, to the repo market data itself, then we can see, we go back to the beginning here, investments by any U.S. money market fund. We're going to go specifically U.S. money market fund repos with the Federal Reserve Bank. Number one is Fidelity. So we go to detail. We go drill down on the fund name, and we look at, what do we have here for SPACs? Government Money Market Fund. So we go back here. We look for Government Money Market Fund. It should be the first one. Fidelity, Government Money Market Fund. And we can get the data to this fund in a spreadsheet, which is very nice. Now, if we look, 2011, not much of anything. But as soon as 2015 hits, take a look. That's when we start seeing data come into play. Now, if we go back to the repo chart, you see what happens in 2014, 2015. We start to see some data come in. That was the pretest there. Now, if we go back to the holdings report in the spreadsheet, it only goes up from there. And then in 2021, when we see the massive skyrocket, you see their holdings massively skyrocket, because this is exactly what you're looking at. This is the repo participants. It's all of these players right here. Fidelity. Let me go back up one. Vanguard, JP Morgan, Goldman Sachs, BlackRock, Morgan Stanley. All the people in the holdings report itself right here. So this is one end of the transaction. This is the repo side. The other end that I was showing you on the website, that is the reverse repo side. The Fed side is the reverse side. The bank side, or the other side of the equation, is the repo side, which happens to be every bank, every big player, all the U.S. Treasury notes and debt, all the U.S. Treasury bills, all of the federal home loans, all that shit piled into these government money market funds, which are cash cows, and then they game the fucking rates. So that's our money, folks. That's in these funds. All of our money. While we have it sitting there, it's being financed for obligations of the United States government. And, you got toll roads, airports, bridges, highways. Everything you can imagine is within these funds. I've done videos on this in the past. The rabbit hole is very deep, my friends. So if you choose to journey into that rabbit hole, just take a look at some of the past videos I've made on my channel involving some investigations into this stuff. But if we look here at the Fed Reserve, this is the Fed Reserve's side right here. Federal Reserve Bank of New York. Government repo, Bank of New York Mellon. U.S. Treasury purchase agreement, if collateralized only by U.S. Treasuries, including strips and cash, $46.5 billion worth on 6/3/2024, which is the latest update for this data. And the other end of this is none other than right here. Same thing. Fidelity, fund manager, data shows with the Federal Reserve. And this is specifically with the Federal Reserve. So if we go and we look at this data, what should we see on that date? Do we have that date yet? No, we don't. The latest date, this updates monthly, so they're a month behind, it looks like. The latest number we have is 4/30. I don't know if I can get prior history data from the SPACs here. The holdings, yeah, that's going to be
for the most recent. Oh wait, hold on. Oh, there we go. April 2024, right there. So we go to April. Let's go to the Fed Reserve again. 26,747. That's the same fucking number, my friends. 26. It's a little bit different, but let's get it exact here. 26, 747, 26, comma 26 billion dollars. And then here, $26 billion. Yeah, it's the full circle, my friends. You have, boom, one side here, repo side here, reverse side here. You have how it works here with the diagram. Then you have confirmation with the Fintel holdings that's exactly what's going on. Same products. It's all a repo fiesta, my friends. And then what else I was trying to show you was utilizing the Greeks. I was showing you GME's different Greeks, explaining them. I'm just going to do this real briefly. But you got delta. Notice how it's symmetrical. Delta. These are the primary Greeks. Delta, gamma, vega, theta. Symmetrical, right? Then we go to the second order Greeks, which is Vana, Bama, Charm, Veda, Speed, Zama. Zama is the most closely symmetrical one, I would say, and that in color. And then you have Ultima. But something of interest that, again, it's just measurements. That's what these algorithms are great for, is doing these quick mathematical measurements on these Greeks, because they really do make up your options contract and how it's priced. And that's how you can be in a call or a put, and the stock can go the opposite direction of where you expect it to go. Like if you're in a put, you would expect it to go down in price for you to profit, but sometimes, depending on the makeup of the Greeks, the second order Greeks, that's not always the case. So, which explains a lot of the questionable price movements that happens, and there is a reason for all this. That's the point to get across. But anyways, I'm gay. Sorry about the no video on the live stream. My bad, but hopefully this makes up for it. Anyways, you all have a good one.